Hey, I hope you're doing well. Now, have you ever wanted to run your own fully customizable trading bot that works with crypto? But wait a second. By works with crypto, I don't just mean that it trades crypto. I also mean that it is successful because it harnesses rather than fights against the main feature of crypto, and that's volatility. You know, crypto is definitely the most volatile asset out there. So we might as well make the most of it, right? Well, that is why today I want to take you on a journey to create exactly this kind of trading bot in Python easily. It will run on a crypto exchange and even manage multiple coins at the same time if you feel like it. And all this for free. Now, if you're curious to know what this sweet little powerhouse can achieve, take a look at these results. Let's start easy with Ethereum and its 764% profits in just a few years. But more importantly, a very healthy equity curve, as you can see, and a stunning win rate of 85%. And all this for a maximum drawdown of only 16%. All in all, it actually gave a very attractive Sharpe ratio of 1.3. Now, let's crank it up with Bitcoin, which boasts a staggering 1041% profits and also a beautiful, robust equity curve. It maintains also a very appealing win rate of 86% and, listen to this, a maximum drawdown of only 7% and a Sharpe ratio of 1.4. Sounds almost too good to be true, right? Well, that's great if you're skeptical, because today I'm providing you with every tool you need to make your own mind. We will also dive deeper in results analysis later and explore other coins. But always keep in mind that past performances are never a guarantee of future results. I can never emphasize this enough. Now, just a technicality. The codes that we'll be using are in Python, but you don't need a extensive knowledge to run everything. I'll be as pedagogical as possible, and as you will see, I've developed everything such that it is very easy to change parameters or setups and test them, and then run what one prefers. But now, if you do want to learn about Python, or you need a refresher about your knowledge, we do have a comprehensive Python for Finance free course available on this channel. You'll find it in this article from our website, robottraders.io. I've linked it in the description down below. The link is here, and in there you'll find all the chapter videos, but also a written format of the course. I've also linked in this article all the resources for this trading bot. So here are the links to our GitHub of the Python codes we'll be looking into shortly. And I've also coded the strategy of this trading bot in PineScript. So if that's more your thing, you can find it here. And here's the link to the video that explains it. Now, let me also add that all of this is absolutely free and open source. This is really the philosophy of this channel. Okay, now let's get practical. I've only shown you some fancy results so far, but I want to emphasize that the real point of this video goes beyond that. It's really about empowering you with all the tools you'll need to effectively manage a trading bot like this. Now, maybe you don't really know and you're not used to trading bots and you're wondering, what does the end game look like? Well, let me show you. So here I am on my Bitget futures trading account. That's indeed the crypto exchange I've developed the trading bot to work on. So what I'm going to do now is simply run the trading bot. And what you'll see in a few seconds is that you're going to have a bunch of trigger orders popping up here and also updating on the chart here. And obviously, all these trigger orders, these orders depend on the rules of the strategy. So these are my entry conditions, my exit conditions, my stop losses, etc., that will trigger or not depending on how the price moves. And you can see as well what I can do. I'm going to run it once again. And what you'll see in a few seconds is that it is going to delete all these orders and going to be placing some new ones. So obviously and there we go. You can see them here coming up. So obviously, for the show, I'm launching the training bot live by myself. But the whole point of this video is also to get it to run automatically on the server. And now we are choosing a AWS server. The reason for this is that it gives a free instance for 1 year. But to achieve all of this, in other words, to ensure that by the end of this video, you're not only capable of handling this bot, but also are comfortable with it operating by itself, we need to go through a few key steps. And of course, this has to begin with a proper understanding of this volatility master strategy the bot uses. Then, as you know, any strategy is defined, but trading strategy is defined by a set of parameters and rules. And before using that strategy with real money, it is crucial to backtest the strategy. In other words, evaluate your choices of parameters and rules on past data. Now, I have said, and it is clear, that past performances never guarantee future results. But on the other hand, if you test and you find out that your strategy doesn't work well with past data, on historical data, then your strategy probably needs to go to the rubbish. So you need to check for that. Also, keep in mind that it is through careful backtesting on various market conditions that you can identify robust parameters for your strategy. So that are all the reasons why we'll take some time to thoroughly analyze some backtest results of this strategy and also go through the Python code that does these backtests. So you can do your own testing, do your own modifications, and possibly create your own strategies with all of that. And then finally, we'll be able to go through all the steps to install and automate this live trading bot on the AWS server. And I will also explain how the live trading bot code works. So again, you can implement your own setup, but also use it as a template to build other trading bots if you feel like it. Okay, enough chitty chatting. Let's get down to business and review this awesome strategy. TradingView will be perfect to get a nice clear picture. So first, let's discuss building blocks and rules. So really, this strategy is a mean reversion strategy, and I've tailored it to work on a 1 hour time frame. So the first building block is really this short-term price average that you see here in white. And from there, what we do is that we compute some key levels. So we simply displace this price average to create those envelopes here. And the concept, the idea with this mean reversion strategy is, as you can see, the price here follows peacefully its life, but every now and then you have an anomaly, a volatility spike that you see here. And what happens with these spikes is that in general, they get corrected quickly. So the price has this bump, but then goes back to the price average quite fast. Let me zoom in a bit. No strategy is perfect. Not all corrections go so fast, etc. But it works quite well, and that's the spirit of the strategy. So as you can see here, what happens is that what we say simply is that when the price hits one of these bands here, we enter a trade. So now you understand what we saw just before, these orders that were placed on the crypto exchange, or those trigger orders that we saw and that we saw on the chart. Well, some of these correspond to exactly these levels that you see here. Technically speaking, I chose them to be trigger orders and not limit orders, because limit orders are a bit of a pain in this case because they block your funds. So when you want to put multiple exits for the same position, the same entry, you have issues. In other words, you can't really put a take profit and a stop loss at the same time because one has taken all the capital and the other one won't execute. So trigger orders are the way to overcome this. Anyways, so those trigger orders correspond exactly to these levels here. So what we see here is indeed that the price hit this price level, so we enter a trade. It actually carried on the wick. I'm not sure you see properly. The wick of the candle goes down to this one. So we enter another trade. In other words, we grow our position. And it actually stopped around here, and we didn't hit the third band. So that's it for the entries. And what happens is a few candles after, the price goes back to the price average, and that's our exit, and we exit all this position, this complete position, all these trades at that level here when the price hits the average. And now in terms of how do we deal with the capital, how does the bot deal with the capital? Because we have to decide what the position size when we enter each of these trades, and that's quite simple. It takes the total capital available given to trade this crypto. So here we are using Ethereum as our example. So given that capital, we divide it by the number of envelopes. In other words, we enter with 33% of our portfolio for Ethereum on this trade and another 33% on this trade. And if we had hit the last band, then that means we would have entered with all our portfolio on this candle. But here we didn't, we only did 2, and sometimes it might be just 1, so we engage only 3% of the trade in that case. That's really a way also to mitigate the risk by spreading our entries on several bands, and the number of bands is something you can customize and choose yourself. So that's that. What I want to also emphasize is that this strategy here, I've singled out one trade, but this strategy, what it really loves is ranging markets where the price really closely follows its average, and every now and then, and sometimes quite regularly, it suddenly does a lot of trades. And you can see there'll be periods with nothing happening, maybe one trade, then periods with a lot of trade. Anyway, let's have a look at this a bit more in detail. I just want to show you a few extra trades. You can see there's a lot of very nice trades happening here. But what's interesting is maybe the second one here, because you see the first position, let me show it. The first entry is here, and then we have another entry, and then the third entry is here. And the exit is at the point here. So what happened? The anomaly was quite strong, so it did change quite a lot the price average, so we only exited at this point here. I think I haven't mentioned this so far, but maybe you saw it already. The bottom bands are green. That's because we bet. We enter a long because we're betting that the price is going to correct going back up. And I think we do have an example here. The upper bands are red, just to show that when the price hits those upper bands, we enter short because we're betting that after the price hits these bands, it's going to correct back down towards the average that we see here. Anyway, parenthesis closed. What I want to mention is that this first trade actually was a loser, this first entry. Let's have a little, let me do a little price range so we can see. So you can see this first one, we lost almost 5%. But the cool thing is we have also those other entries. So this other one here, this one would have given us a plus 2.5 something, okay, 2.6%. And that last one here would have given us a 6% profits. So overall, this total position here, this total trade would have been profitable. But I mean, sometimes you might also have the 3, and because there's a big pump, you might have also the 3 entries that end up being a bad trade, and that does hurt your profits. But so anyways, I think you see the clear picture here. It likes a lot when you have these little bumps, and that's really how the bot works and really manages to catch profits. Okay, cool. We're done with general concepts and rules. So now let's talk parameters, and then we can finish with risk management. Actually, let me toggle this on so we see all the parameters of the strategy. So these are indeed what you'll see again in the Python backtesting code and the live trading bot code. So first things first, the price average, so this white line, what is it computed on? Well, we're using the close, we're averaging over the close of the candles, but technically speaking, you could choose something else if you felt like it. Now, as I've mentioned, it's really a short-term price average, so that's why you see a 5 here in this example. And in terms of the type of average, this is a Donchian channel midline in this example. That's why it does look a bit jagged sometimes, but if you wanted something more smooth or you're used to something else, you could very easily test and choose some other, like this smooth, simple moving average, beg your pardon, exponential, etc. And if you ever even felt like adding your own favorite average in the code, it's very easy. You can do that. There's no problem. Now, in terms of the envelopes, how do we get these levels? Very easy. we displace this price average by a given percentage. So the first envelope here is a displacement with respect to 7%. In other words, to get from here to this upper band, we displace by plus 7%. And to get to the lower band, from here, we displace by minus 7%. Easy. So the next envelope or the next set of bands is now a displacement of 11%, and you've understood the last one is 14%. Great. Then we get to the risk management parameters. So we have a good old stop loss, very important. 0.4 here means 40%. And remember this with respect to what? Well, with respect to the average opening price. So 40% with respect to the average opening price, because that's what's important for margin requirements. Okay, then price jump percentage. This is 30% as well. This is quite a special risk management rule that we'll get back into in a bit. So now at this point, you might be wondering, well, what do I do with these envelopes? How many should I consider? In this example, there's 3, but maybe I should go for 4, 5, whatever. It's a bit hard to give you a general rule and, well, guideline, etc. This depends on you, your feeling, and you have to test for everything. But the general idea is that for more robust coins that are less volatile, that have a more inertia, so when a correction is generally very quickly converted, corrected, and goes back to the average. In other words, for Bitcoin, Ethereum, the really big top cryptos of the market, you don't need too much envelopes. And that's why also we have this very nice kind of smooth curve. By the way, recently TradingView reduced the earliest date you could backtest on a 1 hour time frame down to back to 22. Before it was 21 recently. So that's why I'm a bit sad. There's not a lot of trades to give you a nice, meaningful curve, but we'll get to backtest with much more data when we get to the Python code. Anyways, so that's how you get those smooth curves, is because you've spread across several envelopes, and for the main market caps, you don't need too many envelopes. So now let's look at something a bit more volatile, and we can go, for example, for ADA. And what I do with ADA is that I add an envelope. Because it's more volatile, has more jumps, the corrections can take sometime longer to correct, I tend to go for add an extra envelope and spread them more. So let's just remember, I want to show you this is about 99% profits, a maximum drawdown of -10. And if we now, and a curve that looks quite jagged, but still very nicely smooth. And now what we'll do is that we will simply add an envelope. So I'll just go to add a 0.1717%. So now what you should see is that we did lose a bit of profits, which is really marginal, but we did decrease the drawdown by 3%. So 3% when it was 10% is quite a big change. And you can see, I don't know if we actually see that, but this should be a bit more smooth. So that's how you generally can change the number of envelopes. If I had to give you I'm having a hard time. If I had to give you a general guideline, the more volatility your coin has that you want to trade the strategy on, you spread more the envelopes and add more. So you really spread your capital across several levels, etc. Okay, so I've mentioned this strategy really shines in ranging markets. But that also means it makes this strategy a really good hedging tool, because you can couple it with your more standard trend strategies, which these tend to underperform during ranging markets. But now, no strategy is perfect, and this one is certainly not an exception, and it does come with some risks. So let's discuss them now, also understand the strategy's limitation, and look at what could potentially trigger some big losses if not handled properly. So what this strategy really doesn't like is sudden strong pumps, and therefore also sudden strong dumps. So in other words, very violent, very sudden, strong trends that trigger. So in general, for this strategy, I would really avoid trading coins that react violently to news and things like that. And here we have a case with XRP. So you might remember mid last year, 2023, there was a judge that ruled that Ripple didn't violate US securities law, which was a great news in its ongoing case with the SEC. And as a result of that news, the pump really reacted very favorably for that. So in 1, 2, 3, 4, 5 candles, something like that, the pump price almost pumped by 75%, which is a huge pump, right? But what happens with this strategy, with these, when these pumps happen, is that you don't really have a correction, right? It's not like those nice little bumps that the strategy loves. What happens is that you have this average price before the pump, and then after the pump, now the new average price is way different from that, much higher in the case of a pump. So what happens is that you have this price that shoots up, but also the price average shoots up. And on top of this, it takes several candles, a lot of candles before the candles go back to the price average. So if you had entered the trade here and had no risk management tool, you would only close the trade here. And we saw that's like 50, 60, even 70% the jump. And if you had, for example, used leverage or things like that, it's very probable that you could have been liquidated, that trade would have been liquidated. So that's why first sale, fail safe, of course, a stop loss. But that's not I mean, it is a fail safe, but it's not great, because when you hit the stop loss, you do have a big dent that appears in your portfolio, because a lot of the value that you engaged in that trade here is a full, since we hit the 3 envelopes by definition here, we lose a big chunk of the capital we would have attributed to XRP in the trading bot, if we, of course, chose that. Anyways, what I'm trying to say is that we have this big dent in our portfolio because as a result of hitting the stop loss. So you might tell me at this point, well, that's just simply because you didn't put your stop loss tight enough. Well, that's true. But the thing is, with this strategy, you can't put too tight stop loss because it will work against you elsewhere. Let's have a look. So I'm putting 20%. And what you can see now is that we've reduced this kind of dent. It looks like we've reduced it, but we've created another one. So let's go and have a look what happened at this level here. So we see now what happened is that on this trade, we now got stopped out at the end of the wick. So very large wicks. So I think this wick, like let's go from the price average. That's like a wick of almost 23%. So these are really tend to be liquidity freak events. So some liquidity issues on the crypto exchange, etc. So these tend to happen much less for higher market caps coins because there's more volume exchange, etc. But they can happen anyways. So what you see is that this trade, those 3 entries, so this trade, let's actually have a look. This one, we would have lost a tiny bit of money, 0.5%, something like this. But then the next entry, this would have given us a profit of 8%. And then the last one here would have given us almost 12% profits. So a very profitable trade. But because we tightened our stop loss now to 20%, the price ended up hitting that stop loss. So we're stopped out of our position. So we lose the amount of capital, we lose some capital on that position. So we now created this dent that we didn't have before. So that's an example of why tightening, that's the example, typically the cases that prevent you from tightening too much the stop loss. So what I've done is that I've added this extra risk management tool. So let's put back our stop loss even like to 0.4, but I'm putting the price jump percentage to 10%. And let's actually go back to, I would like to go back to our previous trade that we were having here. So you see now this trade, instead of hitting the stop loss up there and having a huge dent, I have a much lower dent because I have this, what I call the closal rule that exited the trade at this point here. So this rule is quite simple. It's basically saying that If I realize that my previous candle closed at a value higher than my average entry price of a given percent, so here in this case, I'm showing with 10%, then you simply close the trade and exit. And therefore, as you can see, it does help a bit with containing those pumps. And I'm saying that it triggers at the beginning of the new candle if it sees that the previous candle has moved too much with respect to the price average, etc. Reason for that is that the trading bot is always triggered, beg your pardon, is always launched at every beginning of a new candle every hour. So at the minute zero of every new candle. So it does its computation, and if it sees that at the previous candle, we have the close of the previous candle, we have the close or rule that is triggered, then we exit the position. So there we go. Now, with any risk management tool, there's always a drawback. And typically with this one is that if it's too tight or it's there, sometimes it might close a position that would actually correct nicely. So this is a bit of a tricky parameter, and that's why I've made it optional. In other words, in the backtesting codes and the bot code, you can simply remove it and not use it if you don't want to. Typically for top market cap cryptos that have a lot of inertia, I simply don't use that parameter. It's really there if, in case you want to go for more erratic coins or it makes you feel more comfortable, etc., you can just use it. And anyway, that's also the reason why backtesting is very important. Like this, you can judge for yourself if you like a rule, like a parameter, etc. Let me not forget that there is one last rule to this strategy, and that's that if there's any close or condition that is triggered or a stop loss, the strategy, and therefore the trading bot, is not allowed to trade before the price closes back over the average. So at this point here, this is to avoid repeated trades being stopped out or being closed all out. Because here you see, technically speaking, without this rule, because we close our trade here on that candle, well, we do have our price that hits our band and even goes beyond. So technically speaking, we would enter again the trades here, but most likely we would get stopped out again or closed all out again. And that would really hurt our profits even more. So you see, that's why I have the rule that until there is the rule in the strategy, until the price closes above or across, let's say, the candle at this level here, we can't trade anymore. So that's why there's no more trades after that during all this period. But then you can see here, then the strategy started trading again and actually made a nice little winning trade here. Okay, great. I hope you have a fair understanding of the strategy now. If you have any questions, comments, or even later about the codes and the bot installation, etc., please feel free to let me know down below in the comments, or even join our community Discord and ask us there. Now, before we carry on, I want to make an important disclaimer. This is really a pedagogical video. You can use what I present as is or as templates to build upon and create your own things. That's really your decision. But none of this content should ever be interpreted in any way as financial advice. You know, trading with trading bots or trading manually has its fair share of risks, and the biggest of all is indeed of losing your capital. So just keep in mind that you are the sole responsible for what you do with your money. Not me, not the crypto exchange, you. Anyway, now it's time to look into some Python backtests, because like this we'll be able to access more data further in the past, but also we'll be able to conduct a much deeper analysis of the backtest results. I think with this code, it'll be much easier for you to change and test your own configurations, do some modifications, or even potentially create your own strategies with it. So let's fetch this code. So I'll go back to the article of all the links, and that's the link to the GitHub repository. I have called this code Crypto Strategy Lab. Maybe that's not too extravagant. Okay, so in the README file, you have all the steps to install get this code. So we will do that quickly together. I do want to show you because some of you might not be used to all of that. And let me show you briefly what's in the code. I also want to mention If you can give me a little star if you use this code, that would be greatly appreciated. It's good. It helps with visibility. Okay, so in the code, we will get to see some of these files, of course, but I just want to point out what's in strategies. And what you see here is envelope.py. So that's the code to backtest this strategy that we're going to backtest together, the one we've been talking about. But I did add a simple SMA.py here. So that's really, it's a template basically, because the envelope.py code might be a bit complicated. We will review it briefly together. But if you're wanting to create your own strategies, maybe using this simple SMA as a template would be easier. And of course, in the future, I do plan to release more strategies and more trading bots. So I'll simply be adding them here in this repository. Okay, so I said we would do the installation together. So what the first thing we need to do is clone this repository of the code. So I'm just going to copy this. And then I've created here a little codes for this example folder in my documents. So I'm just going to now, what I want to do is open a terminal. This always takes ages to happen. I don't know why. Open in terminal. So here I'm showing in Windows, but if you're a Linux user, I'm sure you know about all of this, and Mac will be pretty similar. So you know what? I'm simply going to put this guy on the side, do a Control V to paste, and here the repository is being closed. So basically, let me show you. You can see that now you have the folder with everything here. So we have all the codes in our folder, but we still need to install the Python packages you needed to run the code. So I'm simply going to actually go, this cd command is just to go in the correct file. So in the folder, beg your pardon, I'm now in code. And I always recommend this. We're going to be installing a virtual environment, basically because we don't want to mess up the packages versions. Maybe you have older versions for some other codes or newer versions, etc. So we're just going to install the versions that work for this code in this Python in virtual environment so that we don't mess up anything with some other of your codes. Anyway, not sure that was clear, but anyways, let's do it. So I'm just copy pasting everything one after the other. And I think, did this go? I think it needs a bit more time. Okay, now I'm going into my .venv. And now what I'm actually going to do is this pip install -r requirements. So pip install, pip is the Python package manager. So that's what's installing everything that is in requirements. So let me actually paste it. Oh, I forgot to put a copy. So copy, then I'll come back to here and do a little paste, and there we go. And this will take some time. There's a few packages to install, but let me just use this opportunity to show you what's in the requirements so you know what we are installing. So pandas, very important for all the data managing. CCXD, this code uses CXD to download all the historical data, and the live trading bot code will also use CCXD to place all the orders and manage the API of Bitget, etc. TA for technical analysis, and that computes our moving averages, all our indicators. Matplotlib, because in the backtest code, we want to do some nice charts. This you'll see is lightweight charts is to do a very nice candle plot with our entry and exit positions. And this IPy kernel is for us to be able to run the code nicely in a Jupyter notebook. The Python packages have finished installing. So what we can do is go back to our code here, and I'll right click on the code folder, go show more options, and then do open with code. So I'm opening the code with this IDE called VS Code. So if you don't know too much about this and you need help installing it and the basics and also installing Python, we do that in the chapter 0 of our Python for Finance free course. Great, we're making good progress. Now that it's all set up, the first thing we need to do is download the historical data on the coins for our backtest. So this is done using this data engine.ipyonb, which meaning a Jupyter notebook. And there we go. And you can see, let me run this. It actually uses this data manager class. This is a class that I've created that you have here. And that basically handles all the downloading and loading, etc. of the OHLCV data. And you can see so far only 2 exchanges are supported, Bitget and Binance, but you can add some more if you want. I don't want to go into the details of this code. I don't think it's particularly helpful. You can always ask me if you're interested. So let's go back to our data engine. So you see here, I'm choosing the exchange to be Binance. I tend to work more with Binance simply because it's an older exchange, and therefore you can access the data on coins up to much earlier in the past. So time frame, 1 hour. You can see I'm giving the list of pairs that I'm interested in to download the data on to do my back testing. So in this example, I'm just doing BTC and ETH. Note that this BTC/USDT column USDT means that this is the futures market. This would be the BTC/USDT would be the spot market. So that's that. You can see that here is what I was saying. I'm declaring a instance, so data of the class data manager. I'm feeding the name of the exchange that I'm choosing. And here, this is a little path that you can give. If you want to store your database elsewhere in your computer, you can give another path here. But if you don't, let me run this. And if you don't change anything, you can see that within the code, there's this data folder that was created. And in there, we will have all the data that we're downloading. And you can see that we just got our CSV. There is in the form of CSV files and it's standard OHLCV data. So date, open, high, low, close, volume. Okay, so what downloaded the data is indeed this little loop. And you can see that I'm using the method data.download, the pair, I'm giving the time frame. And you can also give here a starting and ending date. If you don't give any starting date and you just remove this like that, it'll download all the range available on that exchange. But for this example, I mean, it takes quite a while to download all the data depending on the time frame, etc. So just for this example, I just went for a very recent date, so we don't have to download too much. So you can see it fetched the things. I just want to mention the way the API works is that you can only download the data in batches. So if you cover a long range, you'll have to download different batches one after the other. So it can take a lot of time and you'll have the prints going on like this. And sometimes if your earliest date is too early with respect to the listing of the coin, you'll see a little empty because the batch is empty. Anyways, moving on. I mean, basically you've downloaded the data. It is on the database. We can switch to the backtest code, but there's a few other little things important I want to say. So when you want to load the data, so it's downloading on the database, then you want to load it in your backtest, you use this data.load where you have to give the name of the pair, the time frame. And again, you can choose for a start and ending date. This is particularly important because if you want to backtest on different periods, then you select the dates here in the loading of the data. Then one last thing, you might not be too familiar with how you have to spell the pairs, etc. So if you ever have a doubt, you can just use this little function that I created here that just looks for all the pairs available on the exchange with these characters here. So if I run this, we will get all the pairs that involve Ethereum. And since Ethereum is also often considered in trading for some pairs as a quote currency, you do have quite a lot. And somewhere in there, you will have, I don't think I'll even find it, but you will have, for example, you have Ethereum, USDC. So that's Ethereum futures backed by USDC. I mean, traded with the quote currency being USDC. One last thing I want to mention before we move to really the backtest, something very important. Let me just simply run this. When you're trading, there's a minimal position size requirement. So you can't engage a trade with a too small amount. And that amount depends on the coin. So this here is just a little thing to show you, for you to get what is this minimum price according to the current, what is this minimum amount, according to the current price. So you see, for example, these days when I'm running the code, if you're trading BTC, the minimum BTC with USDT, the minimal size that you can use to enter a trade is around 60 USDT. So it's quite a big value. So you have to keep that in mind because when the bot will be running and you might be spreading your capital across several coins, and for each coin, you're also dividing the total capital of that coin by the number of envelopes. then that could possibly end up giving you a position size that is smaller than this. Note that this, however, it is the counted after the leverage. So say, for example, you wanted to enter a trade with 40 USDT, but then you apply a leverage of 2. That makes a total size of 80 USDT. So it would pass this condition. So this is not included. These tests are not included in the backtest code, but in the live trading bot code, you will get an error in the log saying, I couldn't enter the trade. The position size is below the requirements. Now, time to run and analyze and backtest properly. I did download more historical data for us to do that. So now we're looking into this run envelope script. So first things first, we import the packages we need. So you can see we're notably importing the data manager, but also the backtest analysis library. So this is what I've coded, and you can see in utilities here. We won't go into the details of this. This is just a big class that does all the computation of all the metrics and the KPIs, and does also the plotting to all the good stuff to analyze the backtest properly. This is really based on what we wrote in the Python for Finance free course. Okay, so carrying on, the next one is to actually import the strategy. So the rules of the strategy we want to backtest, and therefore inside all these rules, all of that. So you can see I'm importing envelope as strat, and envelope, you can find it in strategies. So this is imported. I'm instantiating my data manager here, and then next cell, let me actually run it straight away. And what we're doing is fixing the parameters, the choices of the backtest. So we're going to be going for, as our first test, we'll use BTC. In terms of data, you see I'm loading it. And now you can see I've picked a starting date. And so, you know, there's always a debate here on how far back you should go in the past. Of course, you need enough trades to judge your strategy, your backtest properly. But sometimes some people say that going too far in the past is maybe not such a good thing, because you're going to markets that are not as relevant as what is happening today. So you could question, how was the volatility, far in the past? Is it relevant to the strategy now, etc.? So I don't know. This is really, it depends on taste. It's up to you. By the way, I'd be curious to know what you think about this. What is your opinion, and how you handle these, your backtest history, etc., your choices. So let me know in the comments down below. Anyways, for now, what I thought was that going at the beginning, so beginning of 2021, so beginning of the 2021 bull run, could be a good middle ground. So we'll be using that now. Okay, moving on. Now we are setting the backtest, the strategy parameters. So you can see we have our average type. You see for BTC here, we'll be going for SMA. Average period, we'll go for a period of 6. Then using envelopes, these are the exact same parameters I think that we saw when we were discussing the strategy on TradingView. Just by the way, note, if you remove one, the code adapts. It'll understand that you're just wanting to use 2 envelopes. If you start adding more, then it'll understand that here you're going for 4 envelopes, etc. So no problem there. Very easy. Stop loss, still going for this stop loss of 40% with respect to the average opening price. Remember that. And not going for the price jump percentage. So we're not considering this closure rule for this backtest. Now, in terms, a few things I want to say about testing. Maybe the first one I want to mention is there is a mode to just select the longs or just select the shorts if you want to test, just one or the other separately. So that's the way you would do it. If you just don't put anything, it'll be using both. That's the default value. Now here, position size. So this is really for backtesting purposes. So here, if you go for position size percentage, and with 100%, this is really how we've seen on TradingView, and how the trading bot will work, the live trading bot will work, is basically saying that for every trade that it wants to enter, they can access 100% of the amount of money you've attributed to that coin. So if it's 100%, then be divided by the number of envelopes, so 3 envelopes, 33% at the first hit, 33% if there's another hit, and the last 33% for the last hit. Okay, so that's what we will be doing. But I just want to mention, for testing purposes and optimizations, often you don't want to bias by putting more important in your latest trade with respect to your the trades at the beginning of the backtest period. The reason if you're going, why I'm saying that is if you go for this percentage here, well, if your trade, your strategy has been successful or has made some profits, the size of your trades at the end of the backtest will be much bigger than the ones at the beginning. So if you don't want to have this and really have everything judged on equal grounds, you just select a fixed size amount that you use for each trade entries. Again, this is the total trade entry, so it'll be divided by the number of envelopes. So here it means that the fixed amount on a trade would be 1,000 USDT from the beginning of the backtest until the end. Let's go back to this. So we're sticking to this 100% here. And I think, have I run this? I already forgot. I'm talking too much, but let's carry on. So once we've defined that dictionary, our symbol, our data, you can see what we're doing is that we're instantiating a strategy object where here, remember, strat is envelope. So we're doing envelope.strategy and we are setting this strategy parameters and the OHLCV data that we've loaded. Then once this is done, we can actually run the run backtest method in the strategy. So you see here we're giving an initial balance, a leverage that we've set to 1. And here you can see there's two different fees. So the open fee rate and the close fee rate is different. This is to mimic how the live trading bot works, has been designed to work. For the entries, I thought it would be a good idea to do trigger limit orders and therefore save a bit of money by doing like this. Will be on the maker fees. So I think with Bitget, I think with VIP's level 0 is 0.02. So that's that for the open fee rate. Now for the exits. So there in terms of exits, I wanted to be sure that the exits once they're triggered, so whether it's the price touching the average or a stop loss, that the order is, the position is exited immediately, all of it, etc. So for that, the trading bot places trigger market orders, and because that's market orders, we're paying the taker fee. So it's 0.06 in this case. Okay, so I've run this already. So basically, you haven't seen it happening. There's nothing that was printed, but the backtest was run. So it actually took 1.1 seconds. So it was super fast. The backtest was run. Now we want to start seeing some results. So we're running the next cell. You can see that what I'm doing is that I'm running on our strategy that has, whether we did the backtest, we're running this backtest analysis class. And with that done, the first thing we should look into, I think, is all the important metrics. So we're doing results.print metrics. Just by the way, if you want to save like this in a TXT file, you can just, instead of doing that, you just run it like this and give in here a path. So just the path to the folder where you want to save everything. So very simple. Okay, so we're doing that. I've run it. And I think we can look into what we're seeing here. So you can see there's quite a lot of important information. I'm battling a bit with, okay, there we go. So first thing first, recalling the period on which the backtest is done, our initial balance and our final balance. You can see here we got a performance with a leverage of 1 of 130%. The hodling performance is slightly less. So hodling, remember that, oh, by the way, performance, if you hear what I'm saying, is return on investment, so ROI. Okay, so hodling performance a bit less. Hodling means holding, so holding on the asset. So buying with your initial balance all of the asset at the beginning of the period and just never trading with it. So that's the hodling. So we can see that with a leverage of 1, we do a tiny bit better than hodling. Okay, in terms of trades, we're around 59, 60. This is maybe a bit short in the number of trades I'd like to see in a backtest. But anyway, so let's carry on with that. Time in position, almost 1%. That makes a lot of sense. Remember, this is not a trending strategy. We don't stay long at all, and we don't want to stay long in positions at all. What we're trading is corrections, anomalies. So what we really like with this strategy is like a pump, not a pump, a sudden volatility spike, a wick or something like this, we enter the trade, there's a sharp correction, it touches again, the price touches quickly the average, we exit, we make profits. That's very good. So this doesn't take long. It takes, I think we've seen several examples, it takes a few candles. Anyways, let me keep focus. Now we're judging a health section, so we can see win rate of 86%. This is a huge win rate, it's very good, but this is a mean reversion strategy. We want a very high win rate. That's how this strategy is going to make profits. So 86, very good. Okay, now a bit of technicalities. You can see here that I'm showing two maximum drawdowns. It's basically the portfolio balance with respect to which it's computed is not at the same time. So let me explain, and hopefully I'll be as clear as possible. This is the maximum drawdown is always computed, whatever here, with respect to the latest all-time high. That's the definition of the maximum drawdown. But here it is computed with respect to the balance at every time a trade is closed. So that's a bit like, you could say, a bit more of a physical maximum drawdown, while the other one takes into account the unrealized P&L, because this is the maximum drawdown computed at every time we compute the value of the total portfolio, how much it's worth. And the thing is, what we did, let me open again. I open this envelope.py. So that's the strategy. We'll look into this briefly a bit later. But what I want to show you right here is that this comes from the Python for Finance free course. So rather to speed up the code, rather than taking a snapshot of a portfolio at every time frame, so like here we're doing every hour, it could make sense to just do it once a day to speed up the code, to also not have variables with so much information into it. If you're like optimizing, maybe you're running a sort of a random search on top of this code. So this will be executing this code like 1,000, 10,000, 100,000 times, and you don't want that to take a day. So this is one way that will speed the thing up. But that just means that also, as you see here, so this is really the time. So it will compute the equity of the portfolio, so the equity curve, so the plot that we'll see in a second, every 6 hours. It updates it every 6 hours. So if you have opened a position but not closed it, and the position has increased in value or lost in value, this will capture it. Okay, so I think it'll be a bit more clear when we look at the drawdown plots in a second. But what I want to say is that seeing this, a maximum drawdown at trade close or here of just this little amount, I think I would be comfortable in cranking up the leverage. Okay, now I'm really going to sound like an old uncle. But whatever, I must. Maybe I should rename this channel Uncle Louis instead. Anyways, more seriously, you know the saying, with great power comes great responsibilities. And leverage definitely falls into that category. So if you ever decide to crank up the leverage on some coins in the live trading bot, you really need to know what you're doing. And you definitely need to set your stop loss properly to avoid any liquidations. Now with this, I need to discuss also margin modes, at least for those of you who are not too used to futures trading. I won't get overly technical, but I do want to give you the big picture. First, let me actually show you directly in the live trading bot code where this choice of margin mode can be made. I'm jumping a bit ahead. We will look into this script into detail when we're installing this whole live trading bot code on the AWS server and doing the automation. But just to make things a bit more practical, you see here in the parameters dictionary of the live trading bot that you indeed have the margin mode here, which I've put set to isolated as default, but you could also go for the other option, which is cross. And you can also see in the same way that's here you can set the leverage. So what will happen? So this we'll see. You'll put a script per coin. If you want to do several coin, you make the choice of the coin for that given script here. So when the server runs this script, the choices that you've made here for that coin will be directly set, automatically set directly here on your futures trading account on that coin. So it will come here and set things here. Okay, so here we have cross and we have isolated as the default. So let's talk about cross margin mode first. So this is really the riskiest mode possible. And it is really for people who know really well what they're doing and that have a lot of experience with futures trading and derivatives in general and risk management. Because what happens with cross is that liquidation will happen at the level of your total portfolio. So you can lose your whole trading money like that. So if you're trading with a lot of money, it can hurt a lot. So what happens here, let me say, is that if you have like several positions, you have put money in several positions, the bot or you're trading, and you have several positions open at the same time. So your capital has been spread across several positions. Maybe you have some capital left as well. Anyway, what happens in cross is that the margin is shared across the whole portfolio. Meaning, in this case of several positions, if you have a position that drops a lot by many percentage, by a big percentage, but your other positions are in the green, they're pumping, or you have a lot of capital left on the side that is not engaged in a position, then things would be fine. But if it turns out that several of your positions go red and drop a lot, and you go and these put bring your account below the total margin requirement, that's it, liquidation, you lost your money. Okay, so now the reason indeed why I've put isolated as the default, this is because it is what I really would recommend to anybody who's not really well attuned with risk management and futures derivatives trading, is because now a liquidation will occur at the level of a trade. So if you spread, you have several positions, all of that, and one position drops by quite a bit of an amount, well, you'll lose the money in that trade. So you'll lose your initial margin, so what you've invested in that trade, and you will also pay some liquidation fees. But the rest of the account won't be affected. You'll just lose the money on that given trade. And also because it happens at the level of a trade, you can very easily set your stop loss such that you avoid hitting your liquidation. Let's just take an example here. So I'm trading in isolated mode. I'm trading manually, and I'm doing trend strategies, and I see that there's a trend here, and I think it's a great trend. It's going to carry on upwards, so I bet on a long. I enter a long here. Turns out it was a bad call. There is a reversal. It goes the other way, and it turns out that my liquidation price was here. So as the price hits there, it goes down to here. At this point, my trade gets liquidated. I lose the money on that trade. But the thing is, there is a rule of thumb, which the liquidation price is approximately 1 over the leverage in the case of isolated. So if your leverage is 1, you would get your position liquidated if it drops by more or 100% and more. If you have a leverage of 2, then you would get liquidated. The liquidation price will be when your position drops 1 over 2. That would be half, meaning if your position drops by more than 50% or more, you get that trade is liquidated. Now, if it's a leverage of 3, it'll be 1/3, and therefore, if your position drops by more than 33% or 33% or more, I'm really struggling here, then that position is liquidated. In other words, if you're controlling, you have your stop loss, well, you could just say in our example here, well, I'll just put my stop loss before so that I never actually get to being liquidated on that trade, paying that extra liquidation fees, all of that. I mean, you'll be stopped out, it will hurt, but at least you don't get to the liquidation level on that trade. One last important point with regards to all of this before we get back to our backtest results. If you're in isolated mode, the market conditions do force you to never go beyond a leverage of 3. Simply because we saw that because of liquidity events or news or things like that, we do have some big wicks on some candles. And we've seen that more than 20, 25% is something that can happen. And therefore, if you did go for a leverage of 4 or even more, at least with 4, you would have your liquidation level in isolated mode as at 25%. And you would therefore put even your stop loss a bit before. But you would get stopped out regularly because of this. So it doesn't make any sense to go beyond 3 in isolated mode with this trading strategy. Okay, so let's crank up this leverage by 1 and see how it affects our results, especially whether it blows up our risk or not. It doesn't seem so. These numbers, I think, around doubled. So I think we could try 3, that leverage of 3, and see what happens. Remember though, if we're going for a leverage of 3, as we just discussed, the 0.4, this 40% wouldn't make sense. So I'm going to put 0.3. And now we can run this and see what happens. Okay, we get a maximum drawdown at close trades, -4. That's still very good. And at equity here, -7%. Okay, so with these, let's carry on our analysis. By the way, we're noting that indeed now the performance has really shot up. We're more than 1,000% profits, and we're doing now much better than hodling, like by this amount. Okay, anyway, let's carry on what we were, I think we were at this point. So profit factor, not surprisingly, is very high, 35. Same for the ROMAD, return over maximum drawdown, 150. And the, let me put that in the middle. Okay, what was I saying? Sharp ratio, very good. I think it's very good. 0.4, generally above 1. That starts being a good strategy. Okay, and you have the other ratios here. If you know them, here they are. I'm not going to go into details. What I do want to say is that if we're in here, there's some metrics, some KPIs that you're used to, but are not included here. Please let me know. I'm really willing to complement and improve this code. So yeah, don't hesitate. Let me know. Okay, let's go to the trades. Very nice to see that our average net P&L per trade is of 10%, around almost 10%. Average trades per day. Not surprising, this strategy is not a strategy that trades several times per day. As we saw, there's some periods where there's quite a lot of trades that follow each other, but also some long periods with no trades or maybe one every now and then. So we have a small number here that makes sense. This also makes a lot of sense. We saw that this strategy is really a fast get in, get out. It's not a trending strategy or whatever. So our average trades duration around 4 candles for 4.5, so 4.5 hours, 4 to 5 candles, makes a lot of sense. Best trade on that date, and nice to see that it's a plus 14%. Worst trade on that date here, and that's a minus 10%. Okay, a lot of winning trades, not surprising with respect to losing trades, given the win rate. Nice to see that the average net P&L of winning trades around 11.5%, and which is in absolute value much larger than this number in absolute value. So it's nice to see that to have that ratio here. Another thing that makes a lot of sense and that really is a signature of this strategy, as we see, average winning trades duration, 4 candles, 4 hours, makes sense. We saw that what makes a good trade, a winning trade, is generally a sharp anomaly followed by a sharp correction. So that takes just a few candles. On the other hand, losing trades, what makes losing trades is when there was no sharp correction, but rather that the price pumped or dumped. And that means that it takes a few more candles for the price and the average to converge together again. And as we see, this on average in this strategy is around, for this backtest, beg your pardon, around seven candles. Okay, max win streak, max lose streak, much more for the winning. Makes sense, although I'm doubting a bit the relevance of these numbers in general because we don't have so many trades to judge on. Another important thing that to see here is just to show you all the open and close reasons. So this is basically telling you that the open long 1 was hit only 33 times. Then how many times did it manage to go up to long 2? Another 4 times without going to long 3. But how many times did it overall manage, the price went and hit all 3 to the end? Only 6 times. Makes sense that the closest envelopes were hit much more than all the other ones. Okay, Same for exit reasons. So we close reasons, we only have exits. Had a stop loss been triggered, we would see the number in here. Had we considered the closal condition and it were hit, we would also see the number of times here. Also, okay, and finishing, we do see quite a lot of money spent on trading fees here to 266 USDT. Okay, more important information to analyze a trading strategy. If you need this trades info in strategy is a pandas data frame with all the information, hopefully, that you would need on each trade. So open time, close time, the reasons, the price, open, close, margin, initial margin, net P&L, and a lot more information. Just to mention, if you want to save that because you really want to dig into that, check trades, and because you don't understand some or whatever, just to check things, and you want to save this as a .csv file, if you simply use this method that I've coded, save trades info, and you give a path in there, and it will save that as a CSV file in that folder there. Okay, at the same level, same thing for the equity record. So that's what I was mentioning before. So this snapshot of how much your portfolio is worth at each time you do this update here. So in here, you see it here, and you see the strategy. Oh, what I meant to say, same thing. There's a method to save that if you want that. Okay, so next thing, oh yes, I wanted to mention in here, I'm not just using storing the price. The equity, I'm also storing the price because I want to be able to do this nice plot here. So as price, so the price of the asset, what is put here is the close value. Okay, so from this, now we move to some nice plots. You can see that there's a method plot equity, a method plot drawdown for that plot here. And just to mention, if you actually do that and you give a path, it will save that plot at the path that you've given it. Okay, so what do we see in this equity curve plot? Well, to me, this is very appealing. It's a very healthy, slowly cranking equity curve. You can see that the market is going up and down, some periods with less volatility, some with more volatility, whatever. But the strategy is slowly, regularly taking profit on top of on that, and you have this very nice cranking up equity curve, which to me is very appealing. Now, the drawdown plot. So this is quite peculiar, and is quite peculiar to this type of strategy. You see some spikes here. So why do we have some spikes? Well, remember that this equity drawdown is really the drawdown is the drawdown that corresponds to this one here, this maximum drawdown at equity update. So what happens is that you're updating every 6 hours, but maybe every 1 hour. Generally, if it's the more granular, the more spikes you'll see, and way in more depth. But the reason is that this is because of the unrealized P&L. Let me show you the method that does this, updates this equity record, so you'll understand. To compute the unrealized P&L, what you say is that if you have some position open, you mimic the fact that you sell them to know how much your portfolio is virtually worth at the time that you want, so at every time t. So that's what you call unrealized P&L. So you can see in this update equity record, there is a computation of the unrealized P&L. So what I want to mention with this strategy, this unrealized P&L can be often in red, but that doesn't mean you're going to lose the money. Simply, let's take the example of a short, because I'm always putting my hands up rather than down. Anyways, so you enter on a wick, you hit the 3 bands, for example, and we saw that the correction, as much as we'd love them to be as fast as possible, sometimes some candles close further up from that before correcting, and sometimes never, and that's really a losing trade. But what I want to say is that across these several candles where before the correction happens, the candles close above. So if you've entered the short, that's actually going against you in terms of trade. So that will give you a negative unrealized P&L. And typically, you see, when you have a big spike like this, it's quite possible that actually there's a few candles that closed against you, but then there was the correction and that ended up not losing money or maybe a bit or whatever. And that's why you have a spike that comes back to zero. That's maybe even a trade that had this effect, but closed at break even or even maybe made profits if whatever. On the other hand, you do have some rectangles here or things like that. That is typically, that was a losing trade. It closed with giving you a drawdown, and that's that. Okay, so keep that in mind. That's a peculiarity of that strategy. And next plot that we should look into, that this method plot monthly performance with year given as all. Again, you can give a path to save all those plots. This is giving the performance across a year, but of each month in that year. And you can see BTC is great. This backtest looks great. There's a lot of months in green. It's not always the case, especially with assets, with coins with more volatility, etc. We'll see a few more later quickly, but you can see, so 2021, actually across, this is the cumulative performance across 2021. That was a very good year in that backtest, almost 400%, with some months in red, in green, beg your pardon. You see some months with zeros here. Well, that's basically months where most likely there was just simply no trades. Okay, you can see a month in red in March here. Okay, and we finished the year here. Okay, so I think this is quite important if you want to have a detailed analysis, but let's leave it to that for now. Last plot here that I suggest, this plot candlestick that I've created, that I've coded. So this uses just to have a plot just like in TradingView, and I think TradingView is actually based on this or the other way around, whatever. So you get to see your positions here nicely. Okay, that was a very thorough backtest analysis. It was important for me to show you all these details so you see what the code gives you, but also how one can analyze these results. Now I want to quickly show you, not in details like this, but quickly, of a few other coins. We saw the BTC big market cap, not so many trades. Maybe look into a couple more, just more volatile, less high on the market cap coins, so you get a feeling for those as well. Let's look into Cardano, so ADA. So we have it here. I'll just uncomment this. See, I've picked here DCM, 5 average period, added an envelope. You see the parameters here. So let's do a run all and see what that gives us. And we have an error. What is that error? Your long was liquidated on that date. Okay, done that on purpose to show you. What happened is that the stop loss percentage, the default was 40%, and I didn't change that. And we were still using the leverage of 3 because we were checking into Bitcoin. So what would make sense to avoid liquidation, as we saw, 30, that would be at leverage 3, 33%. So I'm putting 0.3. So now, again, I'm doing this, but this is really to show you what to not do, because now we are avoiding liquidation. But what is going to happen is that, this is what I want to click. We have hit a stop loss. And with such a leverage, a stop loss like this is going to hurt a lot. I'd rather warn you, we're going to have a horrible drawdown curve and the equity curve here. You see minus around even more, minus 80% or whatever. So of course, you never want to do that. And I wanted to show you this. On the other hand, it does show that it took the whole period for that strategy to recover from this, but it did recover. It does show you that this strategy does recover quite well from drops in general. I mean, this is a huge drop, so it took years to do. But okay, so take-home message, if you're in isolated mode at least, it's much better to go easy on the leverage so that you can afford a looser stop loss. Because with coins like that those more volatile coins, etc., as we saw, but I mean, it could also happen BTC. We never know what the future brings, but you do have some wicks that go a lot. So there you go. So I'm putting back a 4 here, and I think we'll put back a 2 here and see if this brings things down to a reasonable, in the backtest, a reasonable max drawdown here. And we can see -8 and -10. I think that's quite cool. So just to quickly say, performance, we are really starting to see big numbers. So you see in terms of trade, we have much more here, 200. So much here, bigger performance, more than 200% profits. High win rate, that's really what we want to see. I think I don't want to go through all of them, but just maybe point out a few things. This, I wanted to show you this. This is more the signature of this kind of mean reversion strategies. In general, the losing trades hurt much more than the winning ones. You see that in terms of absolute value. So you see plus almost 8% for the best trade in this case, but the worst trade was -20%. So that's why I was insisting on the fact that one thing that is very important is to have a high win rate, because every time you'll lose, it will hurt your portfolio. So you want to win a lot to overcome this. And same kind of thing. I think Bitcoin was a bit of a outsider in certain sense, outlier. That's maybe the name. Anyways. So what I'm trying to say is that this is another characteristic that you see more in mean reversion strategies, or at least this type of volatility strategy, is that the average winning trade is, and the losing ones in absolute values tend to be more similar. And in trend strategies, on the other hand, you do not want to see that. Generally, these have a smaller win rate. Sometimes it goes down to 40%, and that's okay. But what you want to see is that the average winning P&L is much, 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 much higher the number than the losing one in absolute value. Okay, great. So I think that will be cool. You see, we have more trades. So indeed, we have more periods, more drawdowns here. We have still those spikes I was mentioning, and more closed trades drawdown, those steps. Okay, still a very nice growing equity curve. I think we could quickly see there's quite a lot of green again, but some months in red. I think in general, one should be prepared with trading and trading bots and all of this to have some months in red. Otherwise, there's no point. I mean, these will happen no matter how hard you work on your strategy. Anyways, so I think that's that. Maybe we can have a look at AVAX, which is even more volatile. So you see here, I've added an envelope to kind of mitigate for this, and they're quite close. AVAX here, SMA 5 for envelopes, but I've spread them even more. And I think, okay, we'll keep leverage of 2, and let's see how this goes. Let me do that. We're seeing a huge number, okay, but you can see the maximum drawdown are getting quite high, and especially this equity because of this unrealized P&L thing. So, okay, that's that, but huge number, huge performance, but still risk a bit more. Still getting quite a good sharp ratio, all of this. I think let's have a look at the equity curve. Quite interesting. You see what I was saying, this is really like this unrealized P&L. We have something quite reasonable, but there's one occurrence where this thing what I've discussed before happens. Anyway, nice, very nice equity curve, although it's maybe a bit less smooth. We have a huge win here, whatever. Let's see at the plots. I think we have some red. Okay, anyways, last things that I want to say with respect to this is that I really think with the game with this strategy is to spread your risk across, spread your capital in general. What I think would make sense, and this is not financial advice, really, this is what I think would make sense with this strategy, is really to spread the capital across several coins. Because these were nice backtest. The parameters were doing well, all of this for these periods and all of that. So there's a lot of green, but you will have some months in red, and for some coins there'll be a month in red here, and for another coin it'll be in green, whatever. So if you're trading, you're spreading your capital across multiple coins, you will have hedging going on, where bad performance on a coin might be mitigated by better performance on another coin. But also, it is quite possible that a stop loss on a given coin will be hit at some point. I mean, you can't, that's how it is. So you might have a dent on that coin, on that part of your portfolio, on that coin etc. But the point is, if this is a small part of the capital and your total capital is across several coins, well, this drop will be compensated by the gains on other coins. So I think this strategy really doesn't make sense to go all in on the coin. Really, that would be stupid. It's several coins, small capitals spread across several coins. I think that's the way to go. Again, not financial advice. I think that's how this strategy, what it calls for, in my opinion. Okay, I think we've done more than enough backtest analysis for today. Let me just conclude with one important caveat, is be very careful with overfitting. If you ever get into trying to optimize parameters and all of this, just always keep in mind that just getting the best parameters as a parameters that give you the best results, best performance across a very large historical period is a bad thing, because most likely those parameters will not be able to adapt to the unknown future markets. Really, the best parameters actually are robust parameters that you get from testing various market conditions and finding parameters that do okay across all of these. So they probably won't be brilliant in any of these, but overall they do okay, they do good across different market conditions. And therefore, your strategy with these parameters is much more likely to adapt to the unknown future than something overly tuned to past data. Okay, time to go very quickly over envelope.py. I'm just going to fly through. I think I just want to give you the main structure, a couple of specific points for those of you who might want to come and do some modifications, etc., which I really encourage you to do. So first things first, when the class is instantiated, when you create an instance of that class, I should say, what is done first, notably, you see this populate indicators and set trade mode. So to make this code as fast as possible, we want to do as much computations as possible before we run, you see run backtest, we have this run backtest loop, which goes through all the data row by row. So you want to do as little as possible in this loop and as much as possible before. And beforehand, what we can do is indeed compute all our indicators. So you see in here, I'm computing all the averages. I mean, depending on the choice, this data average will be the one of your choice. And I'm using the TA library, as you can see here, import TA. You can use whatever libraries you want, whatever. Something important here is this shift one, so shifting the computation, the time by one candle. This is very important to avoid any look-ahead bias. Now, moving on, second thing here is after the average is computed, I'm computing my bands. As you can see, for the for the band lows, I'm doing is the average times 1 minus E, where E will be these values that we have here. On the other hand, I've done a little modification with respect to what I had presented in my previous video on the PineScript strategy version of this. Instead of doing times 1 plus E, I'm doing divided by 1 minus E. Why am I doing that? Let me show you. I've prepared this on TradingView. So what was before with this 1 plus E would mean that going from here up to here was plus 7%, and going from here to here would have been, well, displacing by minus 7%. What I've done is that I've created with this correction a tiny bias by favoring a tiny bit the longs, and so therefore pushing away a bit the shorts. And now it means if you set a 7%, it means that going from here to here will be minus 7%, and from here to here minus 7%. Why did I do that? Why did I want to favor a tiny bit more the longs? Is simply because top cryptos have shown to be assets that on average have grown across time. So I wanted to favor a bit more the longs, making them maybe a bit more probable to be successful. So there we go. That's this little correction. I will update the PineScript code according to this modification and the other one that I'll show you later. Anyways, so I think the other thing I wanted to show you, set trade mode, those are some defaults, whatever, but you see populate long signals. So that's the other thing you can do before running the backtest. Again, this philosophy of how the code works actually is described much more properly, I think, in general terms in the Python for Finance free course. Anyways, let's carry on. Just saying, populate signals. So you have the longs and the shorts. Here is populating again our big pandas data frame that we'll be scanning through during the backtest loop. You see here I'm putting the conditions. And basically what will happen with this is that once the condition, if the condition to enter a trade is verified, we put a true, and if it's not, it's a false. And the same thing, if it's time to close, I beg your pardon, the close is here while the long is here. But so when it's time to close, the close row will be a true and etc. So what I was saying, I think this run backtest in general, I don't think you would have to touch it if you modify it. What is quite important to see is that that's the backtest, the loop across all the data. And in here, by the way, you see this update equity record that I mentioned before, that function. But basically whether to enter a trade or not is all done in evaluate orders. So that is, this evaluate orders function will be very specific to the strategy. And that does get a bit technical with this strategy. So I'm not going to go to this in details at all. You can let me know if you have questions. But basically, you see here that you're testing if a long has been opened. Is it time to exit it? So I'm checking all the condition, the price, the close all, the stop loss, the liquidation. And if it's just not simply time to close it, normally when it hits our price average. So you see here for the longs, for the shorts, and after closing possibly, that's the closing part, and here's the opening part. There's two things and I want to say is that when you're backtesting, it's very hard to know if you have a candle, for example, that hit a band but also hit the average. You don't know what happened first. So I'm saying that you cannot enter a trade on the same candle if a position was closed to avoid messing up this. The live bot, since it's going to be placing real orders, if a band hits the top band and then it hits the exit, the bot you will have made that trade, no problem. But at the level of backtesting, is you can't know with the OHLCV data what was hit first. Sorry, I'm struggling. So I don't want to create any bias with respect to this. So I just decided that the rule was that if you've closed a position on that candle, you cannot open a new one. So that's why we have this condition here. So, okay, I'm not going to go into details into this. The other thing I just want to mention is the other change I made with respect to the PineScript code is for the close all condition. I was at that time comparing how much the next candle was closed with respect to the previous one, or at least when you're running the bot at the opening of a new candle, you're checking whether the previous candle closed way above the one even before, meaning the price is pumping. So I'm doing this close all. I didn't think this would make a lot of sense depending on the color of the candle. So I'm simply doing this computation with respect to the average open price, just like the stop loss. I think that makes more sense. Okay. When is this guy going to finally stop babbling so much and show us how to run this live trading bot? Well, now, time to get practical. The first thing we need to do is to create an instance on AWS, a server instance, and then install the live trading bot code there. So let's go. We're going for AWS servers servers provided by Amazon. I think you'll find them just by searching AWS Amazon. Anyway, so we're doing that because they provide this free server instance for 1 year. But you could follow all these steps that we're doing on any other servers, really. Okay, not sure what landing page you'll get to. So what we'll simply say is that we'll search EC2 in the search bar, and then we can just click on EC2, and that's how we access all the server instance. By the way, I do remember there is, I think, a $1 one-time fee you have to pay to create an account on AWS. Okay, so then once we get here, we just click on Launch Instance. Then we'll have to give it a name. So I'm just going to go test envelope, and there we go. Then we have to select the type. So we want a Ubuntu server. So we're going to click here, then everything is fine. Then quite importantly, you see here, this is the instance type. So basically the power that has this, that virtual server has, and the more power, the more expensive. But so this is the T2 Micro is the one that would be free for the first year when you create your account, and then I think it's about $10 to $15 per month after that first year. So we'll just click on that guy. And then next step, that's important. We have to create this SSH key, which is the key that will allow us to connect from our computer to the server instance once it's created. So we'll just do create a new key pair here, give it a name. I'll just go for test and test and test, and then we stick to rsa.pem. Very good. Create that key, and you can see that it got downloaded here. So now it is standard practice to put these SSH keys in the .ssh folder, which will be in your, on Windows at least, in this Windows C, users, Louis, and then here you have a .ssh, and you can just add your key here. So paste it here. And if you don't have a .ssh, I think it should be, but if you don't have it, you can create it. Great. So this is done. We've done we've done the creation of the key. We've put it where we wanted. And basically all of this, we can leave it as it is and then do launch instance. So this will take a bit of time, but at some point, there we go. We have our instance that has been launched here. Perfect. Now we can connect to that instance and install the live trading bot there. So it will then run automatically 24/7. Yep. No respite for trading bots. We can then go to our instances to find it, and we can see here test envelope. So I'll simply right click on that, then click on connect. Then in here, importantly, we go to SSH client, and you can see here that we have this command here that we need to use to connect to the instance. So we'll simply copy this. And then what we must do is go back to the folder where we put our SSH key. And what we can do is directly in the path bar, the search bar here, no, the path bar, can just type CMD and then press enter. What this done is simply it opened a terminal exactly in our SSH folder here. So now we can just paste. So I'm doing Control V, and that's it. And that will use our SSH key to connect to this server instance. So do we want to continue? Yes, of course we do. And now there we go. So what has happened here is that now we're connected to that server instance on an Amazon server. The terminal is no longer on the computer. As you can see, we are in this Ubuntu at whatever this IP address, I guess, of the server instance. So great. So now we can start installing the code here. So let's go back to that article. And now we'll go to this live trading bots GitHub repository, our GitHub repository. And again, you have all the code is in here. And I've just compiled here the steps to follow. So the first thing is to clone the Git repository on the server instance. In other words, download the code there. So I've just copied this here, and then we can just come here and do a Control-Shift-V. So be careful on Ubuntu and Linux terminals in general. It's not the standard Control-V or Apple V. It'll be Control-Shift-V. So that's what I did to paste what I just did. So anyways, we're pressing enter. So basically you can see that we have now downloaded the code on the server instance. A command to see what's in that folder. You can see that in our server instance, now we have this live trading bots folder in there. So that's great. So we're staying there. The second thing we need to do is do this command here, bash live install. So this, let me just copy it now. I've kind of regrouped in one file here in this .sh. Let me show you all the configuration and the installation of the Python packages, everything. So you see this sudo update is just to update the server. This is now to install properly our Python packages. And in there, then what happens is also what is happening here is that we're also installing a virtual environment to run the code, just like we did on our computer to run the backtest code. And you can see here this once this virtual environment is installed, we're going to be installing a series of Python packages in this .requirements.txt, which contains all the package necessary to run the live trading bot code. So I'm just going to show you this as well, so you know what is being installed exactly. So in this requirement.txt, you basic txt, beg your pardon, just 3 packages, pandas, RTA library to compute the indicators, and again the API management and of the code is also done using CCXT, so that's why we're using CCXT. So I think I've already copied this. What we can simply do is now go back to the terminal again, Control-Shift-V, paste that command, and everything is going to get installed by itself. At some point, it does actually take a few minutes to install this. At some point, you'll probably get this thing saying, after this operation, this amount of additional whatever is asking you whether it's okay with you installing those Python packages. So you just can put, I believe, a yes, and that will work, and that will carry on doing the installation. While the installation finishes, let me put on my sales rep hat for a second. Well, whatever. It's the only one I could find right now. Anyways, if you're new to this channel, I'm Louis, and at Robot Traders, our goal is really to democratize algorithmic trading and related topics. If you feel like supporting us, really the best way is by using our registration links. So you'll have all that in the description down below. For example, with our registration link to create an account on Bitget, you'll get some welcome gifts, but probably more importantly, a 10% discount on your trading fees, which can make a big difference, especially in the long run. So what will happen with this link is that if you use this link, is that not all your trading fees will go to Bitget, will get a part back in the form of commission. So thank you very much if you do this. And now let's get back to business. So now with the installation finished, let's go and have a look at the script where we can configure the strategy parameters and the coins we would like to trade. So we're back into the terminal. So we want to go into the live trading bot code. So I'll do CD. That's the command to go into CD live trading bots. I only typed a few letters and then I pressed on tab so that the auto completion did the rest. So you see now I am in live trading bots. By the way, to go backwards, it is CD space ... So if I do that, I'm back into the home of the server. And just by the way, I can go back to my previous commands by using the arrow. So arrow up, I went twice back and I got back to this CD live trading bots. So I'm pressing enter. We are now in live trading bots. I do ls. We see this everything that we saw on the GitHub. We want to go into CD code. So there we go. In there, we want to go into strategies. This run envelope.sh will be using that for the automation a bit later. So I said CD strategies. There we go. And in here, we have only strategies for now, but I do plan on adding some more. So we have envelope, CD envelope. And in there, what do we have? Finally, we have the run.py, which is exactly the script that will be executed every hour to trade the way we want it to trade. So let's say, as an example here, we'll be setting up for 2 coins to be traded simultaneously. So what I'm going to do is copy this to leave it fresh as a template and create new scripts per coin that I want the trading bot to be trading with. So for that, we do a cp space. I need to give the source file run.py. And now the name of the new file I want to give. So let's say that we'll be considering BTC. So I'm just going to call it run.btc. So run_btc.py. There we go. And actually, let's say in this example, we'll just be running 2 coins at the same time. And the other one we could say would be ADA. So there we go. So now if we do ls, you can see that I've indeed created the other 2 .pys. So let's have a look in them and actually configure things. So for this, we do nano and then the name of the file. Let's do BTC first. I open this. And what do we have here? That is the script that will be run every hour, that executes everything, all our rules, all of this. We'll have a look at it a bit in details later. But as you can see, first things here are the strategy parameters. So exactly what we've been talking about a lot so far. It's exactly the same like as in the strategy Python backtest code, but you can see there's one new parameter, which is very important, this balance fraction. So this is the fraction of how much of the total portfolio you want to attribute per coin. So each time it enters a trade, it just accesses to that small fraction, depending on the fraction that you give. So we said that it was going to be BTC. So I better put BTC in this symbol here. So I'm doing BTC. Okay, great. 1 hour isolated balance fraction. Let's say we would give 60% for BTC. So that will be 0.6. I can just put 0.6. Great. I'm not going to change anything for this example. I'll just do Control S to save and then Control X to get out. Okay, we need to do the same thing for ADA. So I do nano run ADA. In here, first things first, I need to give here that I'm going to be trading Cardano, so ADA. Okay, and now balance fraction. Well, let's say I'm going to give the rest of what I've given in the portfolio. We'll do all this of putting money, placing the Bitget account, setting it up, etc. just now. But so anyway, so I'm putting 0.4 here. And actually, speaking of this, what's important, the next step is that we need to allow those scripts, this trading bot, to be allowed to place the orders on our Bitget account and to access the balance and do everything to basically place the orders. So for that, we need to create an API key. And this is what we're going to do now. I just want to show you that the API keys, we're going to put them in this secret.json that you have here. And you might have several keys in there. So I've configured, you see that one is going to be called envelope. So I'm just fetching this key name here. Anyways, so I'm just going Control S and then Control X to exit. And now we want to go complement to add the API key to that secret.json. So I'm going back once, twice, and I think the secret key is not in code, is directly here. As we can see, there's secret.json. So I'm doing nano secret.json. And there you go. You can see that I have this envelope here. So now I need to fetch the API key, secret, password, etc. Actually, rather than jumping directly into Bitget to create those API keys, since I've initiated it, let's quickly go through the rest of the run.py file so you know how it works, what's being executed. Might be interesting if you feel like you want to use this for other projects or something like that. Might be easier to have a look at it on the GitHub repository rather than in the terminal, so we'll do this here. First thing I really want to stress is that I'm not sure I was clear enough with this, but once the parameters here have been set to whatever one wants on the script, there's nothing else that needs to be done. The rest is automatic and it will do what is said to, what is coded to do according to these choices. Maybe the one thing you could change is that if you've changed the name of the key, the API keys in the secret.json, the key name, you would come and change this here. But that's it. Okay, so let me just mention that order placing orders, fetching balance, all these actions that need to be done on the trading account, this is done with CCXT. But what I've done to make my life easier is that I've created a sort of wrapper around CCXT that deals with all these orders. Let me just give you one quick example so you understand why. For example, to create an order, place an order on CCXT is the method create order. Then depending on the parameters that you give, it will be a trigger limit order, a market order, whatever. So what I wanted to do to avoid having to write all of that again and again in the Python code, I've created some functions that take this into account directly. So there you go. If you have questions, you can let me know. So let's go back to the run.py. Okay, so one thing that I need to mention, I needed to create a tracker file per script, so per coin that is being run, because you remember the strategy has the rule, if a stop loss was triggered or a closer was triggered, then the strategy is not allowed to trade before the price merges back to the price and the price average touch again. So I needed a tracker file to track that. So that's here. And the path that I gave is going to be in the strategy/envelope, and there'll be a JSON file in there next to the run.pys. Okay, trigger price delta that I'm defining here. Let me just show you. For when we're doing an entry, we're placing an entry. It's a trigger limit order. So as such, there is a trigger price and there is a execution price, so a price. So you see here, we're in the case of the longs that we're doing. So the price that we're giving, the execution price, is indeed the price of the band. So band low for longs. So given, it'll be a loop across the envelopes basically, but giving the band low. And the trigger price is going to be 1 plus this trigger price delta times that execution price here. So for the longs, we're saying that the trigger price will be slightly above the actual band, and the band will be the execution price. Okay, let me go back to here. So we're taking it step by step. Next section here is the authentication. So to fetching the API keys to allow this script to place the orders and etc. Next part here, functions to deal with the tracker file. Here we are doing is the canceling of the orders. So you have to keep in mind that this script is run at every candle. So we want to update our orders. So we need to cancel the ones before and put new ones with the new values of the indicators because the price average changes at every candle, for example. So we're canceling the orders here. And not surprisingly, the next step is to compute the values of our indicators. And that piece of code looks exactly like what we did in the Python backtest code. Next step here, checking whether a stop loss was triggered. Next step here, this is a funny one here, but it's probably very unlikely to happen. But if it does, we have to take into account this possibility. You might have a candle that hits a upper band and a bottom band on the same candle, right? And depending on the hedge mode, what this would do is that you could have technically a long and a short position open on the same coin. With this strategy, we don't want this possibility to carry on, let's say. So if it does happen, well, this part will cancel and it'll basically cancel the first position that was open. So I'll keep the last position that was hit on the same candle. Okay, so there we go, checking whether a position is open. This is important because if a position is open, we need to update the stop loss to the average opening price, given the percentage. We need to update the values of the exits, etc. And depending how many bands were hit, we're not going to place the same number of orders after that. There we go. So for example, if we have 3 envelopes and 2 bands were hit, we're only going to, after doing this at the end of the code, place one last entry because there's one last band that could be hit. Okay, so checking whether a position was open or not. Here, doing the check whether there was a closal that was triggered. And finally here, this is the checking whether if there's a closal, the position that was open and the stop loss was open, has the price merged back to price and price average touched? And if yes, carry on with the script basically, but if not, the script stops there. There we go. So stops there until the next candle is until there's enough runs to get to the point where the price has touched merged the average. Okay, next section here, we're setting the margin mode and the margin mode and the leverage. So this is really relevant only the first time this script is executed. And then it won't have to update anything because things will be according to the parameters that have been set at the beginning. Okay, so now we get to, if a position is open, we need to do these updates of price. So you can see here, so I mean, there'll be a section for the longs, a section for the shorts. If there's a long, it'll only update given whether it's a long or a short, accordingly. Not sure if that was clear, but anyways. So you see in the updates, what it's doing is updating the exit price. And as you can see, it is a trigger market order. I mentioned that I wanted this strategy for the exits. I decided that I wanted market orders to be sure that they were executed immediately and fully, etc. So that's why it's a market order. So exit, updating the exit, but also updating the stop loss. If several positions were open, we are updating the stop loss to always be the average opening price times the percentage that we discussed already. Okay, let me carry on. Here we're now getting to the last part where it's actually placing orders. So to place orders, we need to know the balance. and we do the balance in this section. And you can indeed see here that we have this balance fraction parameter that times then the leverage, and finally times the total capital that was attributed to the account. So there we go. Now here, well, so here, depending on whether how many envelopes were already hit or not, there's a little loop that will take into account how many are left to put. So if no position was open, it'll put all the envelopes, all the orders according to the envelopes. So anyways, you can see here the entry. So I think this is the case for the longs. So there's a place trigger limit order that we discussed just before. But we're also, every time we place an order, we're also placing an order for the exit. So you have the exit here. We're also placing a stop loss. So you have we're also placing an order for the stop loss. So we have it here. And that was the longs. You have the same for the shorts. And I think we've done everything. Okay, time to create those API keys. Actually, what we're going to do as well is rather than creating them on the main account, we'll create a sub account so that all the scripts or whatever will be trading on that sub account. I think it's much safer and cleaner to separate trading activities like this. Okay, so from my main Bitget account, I'm just going on the top right here, and you see rather than going to API keys directly, we're going to sub accounts. Once we're there, we are just going to create a new one. So we click on create account here. And what we're doing is a virtual sub account. So we're not creating a new email address, etc. We're just sticking to a sub account of the main account. There we go. So that's that. We need to give it a name. So I'm just going to say test envelope. Okay, notes, we don't care. And we see that we can create an API directly at the same time. So let's toggle this. We want a system generated API key. And here we have to give a note. So this, I mean, we don't really care. So I'm just doing test envelope again. Now, this is the first thing that we'll have to paste in on the server. So I'm just going to do I love peanut butter. There we go. And we have to give the permissions of what we're allowing through that API key. So I do want to mention, so this is the first thing that we'll be copy pasting, and then there'll be the API secret and API key. This API keys is all sensitive information that you need to keep absolutely confidential, because if someone gets access to this, it will grant them access to the trading activities on your account. So you don't want to do that. So keep that very confidential. Obviously, I'm doing this live, but then I will be deleting that API key. Okay, so the next step here is permissions. So what are we creating this API key for? Well, we're creating it to trade futures, to allow the live trading bot, the scripts, to trade futures. So we want to toggle this on, and we want to toggle this on, and that's it. So we're doing create. One could bind an IP address. I'm not going to do that. So create, and then you have to go through some security, whatever. So let me do that and get back. So now we have the test envelope here that appeared, and we also have the API here with a 1. So I'm just going to click on the 1. And there we go. We have the API key here, but we can't see the secret key. So for this, we have to click on details, and we have to fill in the passphrase. So I like what I wrote as I love peanut butter, and also do the email check. So I'll see you in a second. Okay, so let's copy this API key and actually come in our terminal. You remember where we had to put things properly. Password, corresponds to this I love peanut butter actually. So I'll just write that here. So API key is what we just copied. So I'm doing a Control V, and we have to do the same for the secret. So I'm just going to come back here, copy the secret, and paste it here, and do a Control S, Control X, and that's it. We've done that. I think we're forgetting one last very important thing for the bot to work, is that we do need to put some funds on this sub account. So let's do that. So we'll go up here on our wallet and click on transfer. And in here, what we want to do is a main sub account transfer. So we'll click on this. Okay, spot of the main account, but we want to get to not the spot, but the USDT M futures of test envelope. So I think I'll put 500 USDT. This will be more than enough to avoid any position size restrictions. And this is done. Okay. So to change accounts, what I wanted to show you is that you just simply come here and click on this wheel, and then you can select the other sub account. Great. This, no. Okay. So trade, we might as well go on futures. and we'll see that this is where the orders will be placed by the bot. But what I wanted to show you is that when we come here and it's updated, we should see that this is indeed account assets 500 USDT. Great. Let me not forget to mention that to mark the release of this new video, Bitget is running a special campaign with us. So if you use our Bitget registration links, you can get these awesome bonuses. I'll let you pause the video if you want to read about the conditions. This is of course on top of those 10% trading fees, discounts on trading fees that I mentioned before. So anyways, once again, thank you very much if you do use our registration links. It really supports us in creating all this free content. Okay. Time to run some scripts. First, I think we'll do it by hand to see that everything goes smoothly, and then we'll set up the cron tab for the automation. So rather than having to run all the run.pys of each coin one after the other, what I did is to create a bash file that will execute everything. So let's go there and configure it. So cd code, ls, and this is indeed the run envelope.sh. So let's do a nano run envelope.sh. And as you see, first line, it fetches, it's the source. So it's saying that we'll use the Python from the virtual environment that we installed. And then you can see, then we have Python 3 executing the run.py, giving the right path, etc. So we did in this example, so let me actually do a Control K, then a Control U. And the reason for that is that we created two, we said in the example, we were doing 2 coins, so BTC, and here the other one was ADA. So that's it. So Control S, Control X. And now what we want to do is run that bash file to see these things finally executing. So I'm going, and this, by the way, this bash file is also what the cron tab is going to run every hour. So the cron tab executes itself from the root of the home folder here. So we're going to mimic this. So we have to do bash and then live trading bots, and we have to get to this bash file. So code, and then the name was run envelope. So now if we run this, we should see things appearing here, which are the prints that we get from the script. And we start seeing all the orders being placed, all of that. I think you can see them happening here on the side as well. So first execution, it was BTC, but now it finished placing all the orders. So now it's doing the ADA. So everything is happening. Okay, so if we get to here, what do we, so we do see on our BTC, we do see some of these orders being placed, great. But what I want to show you is that in open orders, we have in trigger orders, we have 36 of them. Does it make sense? Yes, absolutely. So in both these cases, we considered 3 envelopes. So 3 for longs, 3 for shorts. So that's a total of 6 entries per coin. And for each entry, we always set an exit. So that's another 6. And we always set a stop loss for, again, each entries. So that's another 6. So that's 18 per coin. We're doing 2 coins. We have 36. Very nice. So you can see, I mean, we won't go through everything, but you can see the type. You see trigger price, market order. So those are exits. You indeed see that's a close short. But here we have a open short, which is indeed, so you see here, trigger order market price and market price here, market order. Okay, so that was the exits, but I was saying that on the open short, that's a trigger order. We have the trigger price here, but we also have an execution price because it's a trigger limit order. So that's great. Actually, let's do another fun little check by hand together. Let's pretend that a position has been opened and we see when we execute the script again, what happens to these orders. So, okay, so first things first, let's mimic this. So I'll just open a market long on BTC. Great, there we go. And as you can see, we have the position open around 134 USDT. Okay, all good. So we're now back to our orders. And what we should do is let's pretend that this position was open as the result of 2 bands being hit. So technically speaking, what would have happened is that 2 of those open trigger orders would have been executed. So let me cancel this first open long here and this other open long here. Great. So now we can come back to here and simply what we'll do is run the script, the bash script again. Okay. So this amount of time that it takes here is actually the amount of time to download the OHLCV data to compute the indicators. As you can see, first things first, indeed, we mimicked that we had 3 envelopes, we mimicked that 2 were hit, and you can see that when it canceled the orders, it did count that there is only 1 longs remaining to place. So great, we have a 1 here, okay for the USDT position size, and you can see that because there's only 1 left, it's not going to put any shorts, only longs, and you can see that there's only, a limited amount of orders that were placed. And for ADA, we didn't touch anything, so I just deleted the 18 orders and put back new 18 orders. So now the question is, we have 23 trigger orders. Does this make sense? Well, as I said, ADA, 18, and we didn't change anything, so 18. Now, when we're only placing 1 long, there's 1 long left to place, so that's a entry, exit, and stop loss. 3, 18 plus 3, that's 21, great. But there is a position opened, so for this position, we need to update the exits, so the exit and the stop loss, so that's a 2, 21 plus 2 gets to 23. Great. Okay, let me not forget to cancel all these orders so that when we do the automation, everything works great. And I'll just do a flash close here, and there we go. Guys, final steps of this journey. We now configure the cron tab so that this bash file is executed every hour of every day without us having to do anything. So for this, back to the terminal, and we are indeed at the root. We need to be there at the root of the folder, the home. So we'll just type crontab -e. Now, if it's the first time that you execute this command, it will ask you what editor you want to open the cron tab with. And if you select, you press 1 and enter, I think it will select nano. So I've already done that. So anyway, so let's carry on. Let me just paste the command that we have to write. Otherwise, I'm going to get it wrong, and I will explain it to you. So first things first, this is all explaining how it works, but we'll do it together. So basically, you can see that this is indeed the command that we were executing as by hand in the terminal. So bash blah, 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 run envelope.sa. Great. So it is this command that will be executed with a regular frequency. So then what we're doing here is to say, now in this log, which we're putting in the path here and calling it envelope.log, print in there, save in there all the prints that the scripts, all these scripts that are being run will print. Okay, so but we have these little symbols here. This is just to say that don't only print in this log only the prints of the scripts, but also if any errors happen to be printed, you also print the errors. Great. Now the most important part is setting the frequency here. So let me just explain. You see here the first entry you need to give is the minutes. So we want this to be executed at every beginning of the hour. So at every beginning of every new candle on a 1 hour time frame. And therefore it's the 0th minute of every hour. So that's why we're putting a 0. Then stars mean every. So the first stars is every H, so every hour. Then next star is every day of the month. So, and then next star here, every month. And last star, every day of the week. And there we go. So for this to activate, we need to control save and also exit. And that's done. The cron tab is configured the way we want it to be configured. By the way, let me just mention that if you want it to stop it, you can just come here and just do Control S and then a Control X. And now you've paused that command from the cron tab. Let me put it back. There we go. Control S, Control S, Control X. Perfect. By the way, we didn't see any orders being placed in the background. That's normal. It's not the beginning of the hour right now. But I can't resist not showing it to you happening. So what we'll do is quickly change the cron tab such that it executes every minute of the hour. So we'll get to see this happening together. So back to the terminal, cron tab -E. Let's come down to here. Let's put a star. The star's here. Control S, Control X for it to activate. And then let's see at some point let's go to trigger orders. Let's see them happening. And in a few seconds, they'll arrive. Or let me get back to you when it does. Oh, there we go. So it is happening. They're being triggered. We will end up getting our 36 orders once the data has been downloaded also for the next one. And there we go. Great. Oh, yes, by the way, very importantly, don't forget to, if you do this, ever do this test, don't forget to come back to the crontab afterwards and put back the zero here. You definitely don't want to run the script every minute. It won't do what it is made for. And it happens. I've done it many times to forget this. And I'm also canceling those orders. We made it. You survived the journey. Congratulations. If you have any questions or comments, you let me know in the comments down below or join our community discords. But guys, you know the saying in the crypto community, don't trust, verify. So verify, check those codes to check that they work properly according to you. Do your backtesting properly, do your testing properly. Be mindful with how you deal with your money and how you handle risk. And always keep in mind that past performances don't never guarantee future results. Okay, Uncle Louis, go away. I just want to say, generally, this is the moment where I just say that there's a super cool video on the right or on the left or whatever. But honestly, I think you've seen my face for more than enough for quite a while right now. This channel is about trading bots. We have loads of videos about this. I would really appreciate a like and a subscription if you haven't done that already. And also don't forget the Bitget registration link if you want to create an account. And I think that's enough. Now go get some fresh air. I hope to see you soon. Happy trading and take care.